500 un 0,99, cerquita del punto porcentual, rozándolo, y el Nasdaq 100 1,34% a la baja. Como decimos, contamos con Jay Pelosky, es fundador en TPW Advisory. Jay, thank you so much for having us a few minutes. Good afternoon from Spain.
Hi, Martha. Well, nice to speak with you again.
Jay, we have to talk about labor market because today we've known how U.S. non-farm payrolls rised by 263,000 in November. It's more than expected. Does this data, Jay, confirm resilience, a strong labor market?
Yes, I think it does, Martha, and this is a very important point. Unlike 2008, 2009, or 2001, there are no major imbalances across either the consumer, corporates, or the banking sector. And this is true not only in the US, but arguably globally. And so the expectations that we would have big collapses in demand for labor, I think, are going to not prove to be realistic, because the corporate sector is in very good shape. The consumer is in very good shape. Record low unemployment, as we just saw, considerable savings, $1 trillion still in excess savings. And so we continue to feel that we're on the way towards the middle path, which is, in our view, declining inflation, yet growth better than expected. So we avert a recession in the United States, and we may even avert one in Europe as well.
And Jay, if the labor market remains strong, do you expect a worse evolution of inflation, or a solid employment and decline in inflation are compatible?
Yeah, I think they are, Martha. And, you know, we look to Germany as the kind of example here, right? Germany is one of the most heavily unionized states in the OECD. Inflation is running over 10% in Germany. And yet the biggest German union, IG Metall, just concluded its wage negotiations and accepted a 5% raise in year one and a 3% raise in year two. And so the idea that we're going to have a wage price spiral in either the US or Europe, I think, is a very stale view, a very old view, and is going to turn out to be a very wrong view.
Jay, how do you see the Wall Street reaction today? We see falls, but not very significant.
Yeah, I mean, I think that's exactly the point, Martha. And we've had a big run, right? We have had a very strong month of November, both for stocks and bonds. And yet you have a little bit of a surprise number today, and markets barely react. The dollar, which is the thing we're really focused on, we expect continued dollar weakness as inflation fades and rates kind of stabilize to maybe go down a little bit. We think rates are a little bit ahead of themselves. The big rally in the US is, I think, has gone too far on the rate side. But even here, this jobs report only led to about an 8 basis point backup to less than 3.6%. A month ago, the 10-year Treasury was at roughly 4.25. It's had a massive rally. And so I think people continue to be offsides. The bearish take, the excess holding of cash, the significant underweighting of equities, all these things are, we think, going to be unwound in 2023, which we expect to be a year of policy stability, less macro volatility, and a better environment for investors, particularly outside the U.S. We think the U.S., the equities in the U.S. are going to be kind of flattish, limited upside, limited downside, but that's a great environment in conjunction with a weak dollar. That's a great environment for non-U.S. equity to outperform, and that's what we're seeing over the last month. Europe was the best performing region in the world over the last several months. And we think that type of activity is going to continue.
And Jay, in 2 weeks, we will have a new monetary policy meeting from the Fed. Will be the 14th of December. And we are expecting which will be the next movement from Jerome Powell. What do you think? 50 basis points on the table? It's do you see that movement as the most valid for this next meeting? And how this last data, the inflation data and labor market data can make a new reaction from Powell? And we have to remember that Powell talked this week, and he announced in a few words the pivot that we are waiting for. How do you see this next monetary policy meeting?
Yeah, no, you laid it out very well there, Mata. We don't expect the Fed to kind of ever state that it's pivoting, just like we don't expect the Chinese government to ever clearly say we're getting rid of zero COVID. But it's going to happen, you know, kind of by itself, organically. It's already happening in China, and that's a very big deal for the global economy and for global investors. And we think, as you noted, Chair Powell yesterday or the day before kind of held out the potential for a soft landing, which is what we call kind of the middle way, and we just touched on it a minute ago. So I think that kind of suggests that unless the CPI number for November, which the Fed will have and the market will have, I think the day before the Fed meeting, unless that turns out to be some sort of a barn burner, much higher than expected number, we think the Fed will raise rates 50 basis points. They've already kind of set that up. So for them to do anything other than that would be a problem. And I think this Fed is really trying to kind of direct things in the way that it wants to see events unfold, particularly around financial conditions, right? And this is the tug of war between the market and the Fed is expressed in financial conditions. When financial conditions are tightening, that's difficult for risk assets. When they're easing, that's better for risk assets, but the Fed doesn't like that much because it doesn't want the animal spirits to go. It's a tug of war, which we wrote about in our musings a couple weeks ago. And we think that the jawboning of the Fed and the market reaction is an interesting game, but the reality is that inflation is falling, rates are falling, the US dollar is falling, and the investment opportunity is increasingly outside the United States, where investors are under-owned, stocks are extremely cheap, record cheap versus the US. And so that's the big thing that we're focused on. We think we're on the cusp of a significant multi-year global asset allocation shift away from the United States to both developed and emerging markets. And this is the big game that investors have to really start to focus on.
Well, that's a big game. Jay Pelosky, thank you so much. It's been a pleasure as always, and enjoy your weekend.
Thank you. You too, Mark.
Pues nosotros nos quedamos con esas claves. Bueno, en pocas